All right, good afternoon and welcome everyone. My name is Matt Hearn and I'm one of the partners and financial advisors at Cannon Wealth Management. Thank you for joining us and welcome to Tariffs and Markets, what investors need to know now. And thank you again. I know that everybody is, we're all going through these turbulent times together and we have a lot of questions. We're getting a lot of questions from clients. And so we thought we'd share, we'd have a hour or so here to talk about tariffs and talk about the markets with some of our product, you might say, investment management partners. We certainly have a great panel today that I know that you'll enjoy as much as I have, just hearing from these guys and their respective investment firms and the research that they've put together for folks. It sure has been an interesting ride thus far this year. I remember back in December sending out an article to our investors saying we were likely in for more volatility in 2025 due to the U.S. large cap stocks appearing fully valued and the potential for policy uncertainty. And boy, did we get it, right? This has been an interesting year to say the least and somewhat exhausting. Every market downturn is different. This one is different. So we'll talk about some of the nuances and we'll kind of just share a quick agenda today. We're going to start out with some basic definitions. What are tariffs? What are these things that we keep hearing about? Why are they used? What are the typical responses, or what is the effect of tariffs? And then we'll dive into some recent action that has led to this market volatility, the response from U.S. trading partners around the world, potential impacts to the U.S. economy and markets. This is where I'll turn things over to our investment management partners and let them share. And then finally, we'll wrap up with some question and answer time. Please, as you watch today, don't hesitate to ask any questions you might have. I'll be watching the little toolbar down at the bottom here of my screen for any questions that come through. And we will do our very best to answer all of them at the end of our time together today. I'm going to try really hard to get you out of this webinar by 5 p.m. Eastern Standard Time. So we'll dive right in. Let me go ahead and introduce our panel. First of all, we'll hear from Armand Leeks, who's a relationship manager at Capital Group. Capital Group is the home of American funds. He joined Capital Group last year and has 10 years of investment experience. He lives in Alexandria, Virginia with his wife and 3-year-old dog, Ruby. Outside of work, you'll find him biking around trails in Northern Virginia. So that sounds like fun. Second, we have Nick Johnson with us today, Managing Director for JP Morgan. He has been with the firm for 16 years and in the industry for about 20. He lives in Charlotte with his wife and 2 kids. Emma, who is 11, and Graham, who is 3.5. That half is very important, isn't it? In his spare time, he operates an unpaid Uber driver for his daughter who plays lacrosse and swims. How many of us parents can relate to that? And then third and finally, we're joined by Chad Gustus, a regional director with Vanguard. He joined them in 2011. Prior to Vanguard, Chad was a small business consultant specializing in business growth and new client acquisition. Just curious, Chad, what do you do for fun? I failed to ask you that earlier.
No, I failed to deliver on the bio. For fun, I have a 7 going on 17-year-old daughter. So if anyone in the audience wants to give me any parenting advice, I'm all ears.
All right. Lots of fun. That's a great age. All right. Well, again, please feel free to send in your questions throughout our time together. I'll be looking for those, and we will certainly try to get to all of those. We love to get your questions. Let's get started. So I'll go ahead and stop sharing my screen. There we go. All right. So first question, what are tariffs? Tariffs are taxes, or you might say duties, on imported goods by a local government. Why are they used? Well, their intent is to protect domestic industry, encourage local production, generate government revenue, reduce reliance on foreign goods, or respond to trade policies of other nations. And oftentimes we get the question, well, what does that mean? What is the impact? Tariffs can raise prices, often do raise prices for consumers. They affect trade relationships with other countries and influence economic growth. Um, what happened? What caused all this market turbulence? Well, back on April 2nd, President Trump, his Liberation Day, the so-called reciprocal tariffs were much more dramatic than the market thought they would be, that economists thought they would be, that investors thought they would be. As of 2023 data, U.S. imposed a tariff of about 2.2%. And the average tariff, specifically just speaking about tariffs themselves on U.S. goods going to other countries, was about 4.6%. On April 2nd, a 10% baseline tariff was imposed on all countries, and many more tariffs or higher tariff rates were announced on certain countries. And then, as of yesterday, there was a 90-day pause on the higher tariffs. But if everything stays as it's announced right now, once the 90 days is up, if there's no negotiation to bring the rates lower, the average tariff rate will be about 25% on goods coming into the U.S. from other countries. What has been the response? Well, already we've seen some countries respond. China had already been hit with 10% tariffs on February 4th. They responded with 10% back almost immediately. Then on March the 4th, the U.S. went to 20%, and China responded with 15%. And then on April 2nd, President Trump announced an additional 34% rate. On April 4th, they responded with 34%. Then on April 8th, the U.S. went to 104%. China responded with 84%. And on April 9th, the U.S. went up to 100, and that's yesterday, U.S. went up to 125% on China. So China is now at a tariff rate of 125%. This represents a trade war, right? I mean, there's not any way to kind of mince words there. But how about the rest of the world? Japan wants a deal, from what we've heard so far. The EU has tried to sound tough, but so far has not really escalated things with a higher tariff announcement. Britain is trying to negotiate a free trade agreement with the U.S. Australia and India are trying to get the tariffs down as well, and others are trying to negotiate. What does this mean for the economy and markets? Well, tariffs, of course, are a tax on goods coming into the country. Either a company can eat the tax itself or pass along that tax to the consumer, or a combination of the two. And in the first Trump term, we saw a lot of the combination of the two. We saw companies eating some of the tariffs, and we saw them passing along some of that to consumers. Approximately 65% of U.S. GDP is consumer spending, and any increase in prices will put some pressure on the consumer. Coming into this, we have already seen a slowdown in the economy, and this has the potential to slow consumer spending and consequently the economy even more. Additionally, companies are slowing their capital spending due to uncertainty. Uncertainty is probably the word I've heard the most in 2025 so far. Maybe that'll be the word of the year. Companies have and will continue to pause their capital spending, pause hiring, pause inventory, and so on, just as they wait and see what the final outcome of these negotiations are. So with all that said, I'd like to transition to our esteemed panel. We are very interested in hearing what each of your respective firms are saying in response to these recent events and resulting market volatility. Let's get started with Armand with Capital Group. Armand, we'll let you take it away, and then we'll transition to Nick with JP Morgan, and finally Chad with Vanguard. Armand?
Awesome. Thank you, Matt. And am I coming through clearly?
Yes, you are.
Awesome. Perfect. Well, first and foremost, thank you all for joining us today. To Matt's point, what is going on? Obviously, we all are experiencing this volatility. And if we take it back to 2018 or a bit further back, it's often missed on investors that tariffs have been incrementally in our economy. And if you compare 2012 to where we currently are today in terms of the stock market, we have continued to be resilient as a as an economy and the market as a whole. With that said, the current tariffs that are coming out feels like every other day now. We at Capital Group, home of American funds, we do not have a crystal ball as to what is going on, but what we have put together is a four-box framework around, okay, how should we be thinking about these current tariffs and what are the implications about that? And that four-box framework is what I'll share with you all today. The first is decoupling. The second is rebalancing. The third, negotiating. And the fourth, funding. So decoupling, what does that mean? These are tariffs that are geared towards shifting our supply chains away from other countries and reducing reliance, on certain countries, i.e. China. The shift in decoupling has been going on since 2018, 2019, and we've seen that reshoring and nearshoring activity. And some of the industries that have been impacted with this decoupling are technology, energy, pharma, biotech, and aircraft as well. We think that these types of tariffs will be here for the long term, and they will have a high impact for our economy, but a positive impact for our economy. The second bucket, which is rebalancing, this is where I'll say the meat of our focus has been. That's around, okay, how can we rebalance trade? If we think about this rebalancing bucket, there are initially when our information was sent out, there were roughly 15 countries in this bucket. Now it's up to call it 70, 80, etc. But Matt hit on some of the main players that we are trying to just figure out um, a good trade deal with some of these countries, that being China, that being Japan, South Korea, Vietnam, Mexico, Canada, Brazil, and the EU as well. And some of the industries that are impacted here, we have autos, steel, agriculture, food, chemicals, defense, energy, oil, etc. And the outcome from these tariffs here, two things. One, we think they have a medium-sized impact to our economy, and whether or not um, some of these countries work out a deal with us, our thoughts are mixed on that right now. We say that because some countries that we work with, actually, we're at a trade surplus, not a trade deficit. So long story short, in that rebalancing bucket, there's a lot to unpack there. Um, and it's not all bad in the rebalancing and trade side. The third and fourth bucket, that being negotiating and funding. The negotiating bucket that we have, these are tariffs that are sent out simply for negotiating tactics. Think um, President Trump's comments around fentanyl and the crime that's coming over from Mexico and other countries. We believe that these tariffs have a one low impact and also are temporary. Some other countries that are thrown in there are Canada as well, along with the EU. And some of the industries that are impacted are semiconductors, energy, consumer electronics, and steel as well. And last but not least, the funding bucket. That tariffs that fall here are tariffs that are used or potentially used to lower the income taxes here in the US. At Capital Group, we do not believe that these tariffs will actually be enforced. And with that said, we don't think that the president's comments around the motivation of the tariffs is to lower taxes and increase revenue for us as consumers. We don't think this in the cards. At the end of the day, again, we do not have a crystal ball, but this is simply our framework, how to put our arms around an elephant right now. Our base case for the US, it's that the United States can weather changes to trade policies. We do feel that, yes, these higher tariffs may dampen economic activity. They will raise import prices, but the US has the advantages of size, economic resilience, and consumers who have money to spend. And there's an old saying that you'll often hear in finance in particular, it's never bet against the US consumer. With that, our outlook remains sunny with the chance of thunderstorms. And right now, we are experiencing those thunderstorms. Um, in terms of GDP growth for the year, our expectations are still within that 2.7 to 3% GDP growth. My estimate is that our economists may pull that back slightly, but still positive overall. Some key points to take away here is one, to Matt's point earlier, tariffs are used to help protect domestic industries along with other purposes. And at the end of the day, the president is looking to lower our trade deficit, which we all know it's at a near record high. The tariffs initially may seem complex, but if we sort out some of the noise, there are some tariffs that will be here for the long term and others that will fade. Two other items, the increase in volatility. We've seen that, we're living it today, but please do not forget that there are tariffs that were implemented into our economy in 2018 with President Trump's first term, as well as back in 2012 under President Obama as well. And again, the market has continued to be resilient through that. Those are all of my prepared comments. I will go ahead and turn it over to Nick.
Wonderful. Great job, Armand. Well said. I would say JP Morgan agrees. And, it might make sense to try to discuss, in addition to what Armand said, like, why is this happening? Because it seems like unnecessary chaos that we don't need right now, right? And so some of it stems from federal finances, all right, which we can get into. Unlike my golf game, I'm going to try to play this like right down the middle from a political standpoint. No bias, but like, here's what we know. Not saying we agree or we disagree. This is just the facts of what Trump 2.0 is trying to do. Obviously, it's brought, as Armand put, a lot of recent volatility. But before we can really form an opinion, I think you have to discuss why this administration is doing what they're doing. And it's kind of amusing that, markets seem to be shocked by people doing exactly what they said they were going to do, right? This is what Trump ran on. Everything that happened over the past week was announced months ago. Stephen Moran, who is one of Trump's economic advisors, wrote a paper back in November 2024, A User's Guide to Restructuring the Global Trading System. If you have insomnia, go ahead and read it. It'll put you right to bed. I'll try to summarize what they're talking about, though. And he laid out everything, what they've done and what is yet to come. And it's not some philosophical rant. It's a detailed policy playbook. And essentially, almost all trade is denominated directly or indirectly in US dollars. And that leads to most countries being net dollar importers. That leads to trade deficits. And the US dollar strengthens, it appreciates. That makes American exports a lot less competitive. And to this administration, it poses an existential threat to America. So being the global reserve currency has a deep kind of longer term cost. Global GDP grows and it becomes really burdensome for the United States to finance all these reserve assets and be the defense umbrella for the entire world, which we've been since World War II. And that completely ends up gutting manufacturing and tradable sectors in this country, which drive to any small town, that's outside of, say, Charlotte, Raleigh, Greensboro, Winston, just in my neck of the woods, and you'll see it, right? And if you read into the economic advisors guiding Trump 2.0, to Armand's point, like China, their trade policy is an existential threat. In essence, China uses their heavy government intervention and export policy to try to accumulate wealth. And one of the quotes in this paper was, China has chosen to double down on its mercantilist export-led model to secure marginal income, much to the rest of the world's consternation. And I think Trump 2.0, excuse me, acknowledged the key failure of the previous tariffs from Trump 1.0 that carried into the Biden administration, which is frankly, they were too narrow. So they're smart. To avoid the tariffs, originally, they just exported goods to other countries that were not tariffed and then re-exported those to the United States. In other words, like Chinese exports to the United States were just rerouted. And so why universal tariffs? Well, that closes the loophole by forcing trading partners to choose between us, America, or China. And so that's why you're seeing across the board tariffs, which seem completely chaotic. Like, why are we doing this? And we're taxing islands that just have penguins and no human populations, but technically you could reroute through that island if you wanted to. So they're asking for better trade terms, but if you're starting from zero with no threats, like nobody's going to agree to better trade terms. Why would they? Um, so that's why you get across the board tariffs, and they can be used to pressure other nations to join our tariffs against China. And the U.S. is going to grant, we think, tariff relief to countries that meet our conditions. If other nations accept kind of the higher U.S. tariff, at least they're paying revenue to the Treasury, and then they're limiting security obligations of the United States. So it's a negotiation starting point, in our opinion. The end goal here is kind of a tiered system. We think, this multilateralism with a lot of countries involved is out, and bilateralism, us and the European Union, us in Canada, us in Mexico, like that's in. All right. So this is a complete reconstruction of global trade policy within the U.S. And with the U.S. marked as the key prize, tariff relief as the price of entry. Is it going to work? We have no idea. Our economists are very pessimistic because they hate anything that's not free trade. But if you listen to people like Scott Bessent, you get kind of optimistic, like maybe this is a good policy. All right. And why? Government spending, Chairman Jay Powell from the Fed has said it is unsustainable. Government officials have said it is unsustainable. We're rapidly approaching 130% debt to GDP. What happens when we get there? I don't know, maybe nothing. But traditionally, countries at 130% debt to GDP either get inflation, they default on their debt, or a minor economic depression. And yet, every administration, Republican, Democrat, just keeps continuing to kick the can down the road. They don't address the issues. Like him or hate him, Trump is really not doing that. He's trying to rip the Band-Aid off. Markets are not liking it. But if our budget is $7 trillion, we have almost a $2 trillion shortfall. We're bringing in 27% less in things like income taxes than we are actually spending. How do you fix that? You can raise taxes. A lot of people don't want that. Or we can cut spending, or we can do a combination of both. Trump doesn't want to raise taxes. He wants to cut them. He wants to cut spending through Doge, and then he wants to use tariffs to temporarily bring in income to the U.S. and then eventually bring back enough jobs in manufacturing where we're bringing in even more income taxes than we were before. How does that math add up? I don't know. Scott Bessent thinks 300 to 600 billion a year in tariffs initially. That cuts into that 1.8 trillion, deficit gap. And then with Doge, look, it's really, really hard for us to get up to them cutting 400 billion. And that's if they go after non-defense discretionary spending, which is currently like $1 trillion. So they have to cut almost half of that. Department of Education, USA, AID, OSHA, IRS, FAA, Social Security, EPA, Interior, they can save some money this way, but to really, really get to say 1 or 2 trillion, which is what Elon was talking about, I think 2 trillion is out of the question. You got to get to the muscle and the bone of the budget. That's the national security budget or entitlements. National security budget's 1.5 trillion. Could you say we're done being the police watchdogs for the rest of the world? We're just going to take care of national security domestically in America, cut the national security budget in half and save 500 billion. What is Germany doing right now? They're ramping up their own defense because they don't trust that we're going to protect them anymore. Entitlements, Medicare, Medicaid, Social Security is 5 trillion. Can you reduce that? maybe you could do some means testing, but you're not going to be in office very long if you take away people's benefits. So real quick, I know I'm at time, but what happened last week? As was mentioned by my colleagues here, Tariff Liberation Day was far worse than expected. All right. The White House kind of broke a core covenant of capitalism, which is a stable and predictable regulatory environment. And companies are now faced with like massive amounts of stranded capital or capital that's going to earn a lower return. Just as an example, if you look at Apple and their cash flow, like 30% of their cash on their books is now almost going to be tariffed. So it's almost like our government has almost nationalized Apple. Markets don't like that at all. Now, we thought stocks were far too stretched to the downside. Recession risks, we think, are excessively priced. We don't know when stocks were going to bottom. Hopefully, it was yesterday when we saw almost a 10% rally, which is crazy. But two paths, and I'll wrap this up. I think there's a window. We think there's a window, much like Capital Group, that this tariff war can follow a path that leads to the economy and equity markets reaching a positive outcome. And what is the key? We need like an equilibrium reciprocal tariff, specifically with the seven most important nations, which would be Canada, Mexico, European Union, Japan, South Korea, Vietnam, and China. All right. The positive path, and we're going to be optimistic. We still think this will happen. We think this administration knows what they're doing, even though it seems really chaotic. The positive path is extensive bilateral agreements. The U.S. is able to reduce their trade deficit, okay? And this doesn't mean deficits go to zero like Peter Navarro is talking about, which is kind of crazy, but it's improving our deficit would be really, really beneficial to the U.S. And that path is visible if in the next 90 days with this pause, the U.S. can outline what an agreement looks like, because we have no idea. And it's probably going to happen with like Japan or South Korea first, we think. But if we can get a template and the markets believe it's going to work, there's your roadmap for future agreements. The negative path, and what the markets were focused on last week and still are, is that these reciprocal tariffs are going to be viewed as the end destination. And the tariffs are placed for an extended period of time. That essentially freezes the economy. U.S. businesses don't know how to react. Like I mentioned, U.S. duties are a meaningful share of companies' cash flow. And this kind of shock to the economy, this ripple leads to this cascade of slowing economic activity, potentially a recession. And the shock period just lasts and it's large. And then financial conditions are worsened. And that's what the stock market has been pricing in and why it's sold off like 21% from the top. I think the odds for the positive path after yesterday are better. All right. I don't know what those odds are. All right. But we should be thinking that way. And I think in the next 90 days, the administration is going to come out. They're going to announce trade agreements across the world. I can just envision Trump, right? Like, is just as he is, as narcissistic as he is, saying like, look at this win and look at this win and look at that win. And markets might, actually really like that. Maybe that doesn't happen, but I think that's the positive path for this. And we're still in that camp. That could change, but we will see, and we think markets will appreciate that. With that, thank you. I think we've got time for questions, but let me pass it on to my colleague, Chad.
Thanks, Nick. Appreciate it. And again, appreciate everyone for taking some time out of their day and sharing it with us to get some different types of perspectives. I'm going to just talk a little bit about, they always say a picture's worth 1,000 words. So Matt, I think I have a few slides that I sent over. If you could share them on your screen. I'll just try to put it into context in terms of, yes, we've experienced a lot of volatility, and I don't want to be dismissive of that. Right? We're all experiencing it, but let's put it into context in terms of, is this part of what it means to invest? And in a lot of ways, we would say yes, right? Like you have to be able to stomach, right, some of this volatility to reap the rewards of the markets overall. So what we're looking at here is kind of a sentiment of what I just said, right? Downturns are not rare events. In fact, if you go back to the early 70s and you've been investing for about 50 years, you would have experienced 13 bear markets. Okay, what's a bear market? Right, bear market is a downturn of 20% or more, right? That's a substantial amount of a downturn. But again, that's over a 52-year period. That means that you're going to, or you would have experienced a downturn like that or a bear market once every 4 years. Go to the next slide. This just highlights volatility, right? You're probably looking at it and saying, Chad, a lot of squiggly lines here late in the day. The main takeaway is the light color is the S&P 500, right? From 1982 through 2024, generally moving in an upward and to the right movement. And the dark line is the volatility within the market or the last 30 days. And you can see these spikes. And if you look at where those spikes are, probably not as memorable or hard to see, but that first one, that's called Black Monday, right? That was 1987. The stock market in a single day went down 23%. If you keep fast forwarding through time, right, in the early 2000s, tech market or tech bubble bursting, global financial crisis, again, a huge spike. We get into the next spike that's near the right-hand part of your screen, COVID, right? We went through it. It is human nature, right, to get and feel angst. Staying in the market, a simple analogy that I always share is like if you're at the beach with your family, right, and you're in the ocean enjoying a beautiful summer day and a shark comes by, what do you get out of the water? Everyone does. Investing is almost saying there is a shark in the water, but you got to stay there, right? You got to be able to stay there to be able to reap the rewards, not get bitten by that shark. Next slide. You may say, well, Chad, with all of what you just said, and I'm seeing those spikes, maybe at times I should just go to cash. This is just representing if you do go to cash, your likelihood of underperforming, and again, a lot of numbers here. What's the probability? That's the big number. And then in small print, it tells you the approximate underperformance that you had against the 60-40 portfolio. 60% stocks, 40% bonds. You make that exit to cash over a 3-month period, 3 out of 4 times you're going to underperform. Likely or average underperformance is going to be just over 4%. Stay there a little longer, 6 months, 70% probability, and now you're up to almost 7.5%. Stay in cash or exit to cash for a year, almost 90%, almost 9 out of 10 times you're going to underperform. And now you're ratcheting that underperformance all the way up to over 13%. If we go to the next slide, again, let's just look at it from putting money in the market, $100,000 over 30 years, 1994 to 2024. The top line is saying I stayed invested that entire time. You would have reaped the rewards of $2.2 million. Second line says I missed the 5 best days. I'm going to say that again. That's 5 days in 30 years. 5 days in almost 11,000 days. You would have been down 37% against just staying invested. And you see where this is going. You miss 10 days, you're down over 50%. You miss just a month out of 30 years, 83%. You may be looking at the bottom and say, well, Chad, I'm going to miss both the best and the worst days. I'm going to get that additional 10%. If we go to the next slide, though, how are you going to do it? Right? All of these little lines are just showing positive and negative days over that 40 plus years. And what the top there in blue says, or teal, 10 of the best 20 days occurred during years when the market was down, right? And on the flip side, 11 of the worst 20 days occurred in years where the market ended up. So your ability to time, especially when we're talking about 5 or 10 days out of 11,000, it's probably not going to be where you should be spending your time. You should probably be having a conversation with Matt and his team about what you're going through, the emotional side of things, making sure that the plan that you have in place is going to get you to your overall goal. We go to the next slide. Again, a lot going on here. I'll walk us through in just a moment or two. On the left-hand side, right, you see dots and you see the colored bars. The dots are what is the probability of negative return just on paper. The bar says if you take into consideration inflation as well. So if you go 100% in stocks on any given year, 1 out of 4 times, you're going to have a negative return. But as you stay longer, your holding period goes up to 10 years. It's only less than 1 in 20, right? It's only about a 4.2% chance. You may say, well, Chad, maybe I'll just hang out in cash, right? In treasuries, I see those dots. They're really close to the bottom. Only about a 1% chance, right? Over 1, 3, and then as you get out to 5, 0% chance that I'm going to come out with a negative return. Yes, don't forget about the bar. The bar is going to say that over a 5-year period, there's almost a 50% chance that when you take into consideration inflation, you're actually going to be better, or you're going to be worse off by just sitting in cash. Then finally, the magic is on the right-hand side. Diversification, 60-40 portfolio, mixing stocks and bonds. You can see in any given year, it's about a 1 in 5 chance that you're going to have a negative year. But as you get out to that 5-year point, only about a 1 in 20 chance. And again, not that high of a bar saying that you're going to outpace inflation, right? You're going to be better off. You're going to have more purchasing power in the future. If we go to the next slide. Again, different ways of looking at the same thing that we've been talking about. Bear markets, I mentioned at the beginning, you would have experienced about 13 since 1972. They are challenging, but think about it in terms of time, right? Bull markets last a lot longer than bear markets, right? In fact, almost 5 times as long. And while that pain that you're going through is difficult, again, don't allow the emotions to override a well-laid plan. Reach out to Matt and his team. Ensure that the plan that you have in place is appropriate for your goals. And I'll share with you just 1 or 2 other slides here at the end. You wouldn't mind going to the next one here, Matt. This may be something to always think about in the back of your mind, depending on how you're allocated. Again, lots of numbers going on. I'll walk us through it. Left-hand side is 100% bonds and no stocks. The right-hand side is no bonds and 100% stocks. And you can see, right, the dispersion in terms of the highest of the highs and the lowest of the lows. And that's over a 98-year period. Those blue dots, or I'm sorry, those black dots along the way, that's what the average return is. So again, a lot of people want to say, well, I want to maximize my return. You got to also put it into consideration. Are you able to stomach those high of highs and those low of lows? And the last thing I'll share with you, if you flip to the last slide, Matt, is the fact that we talk in this industry, and I am a part of this as well. We talk in averages all the time, right? And what we try to do here is really put into it on paper, how often do you really experience, right, the average? Again, a lot of stuff going on your screen today. I'll walk you through it. The gray bar that is running east to west, right? That's your average bond returns. And if you're looking north to south, thank you, Matt, for highlighting that. If you're looking north to south, those are average stock returns. And what we did is we overlaid them to make it an X, and we said, how many times in the last 98 years did you get average returns in both stocks and bonds in the same year? Twice. Say that again. Only 2 times in the last 98 years did you get the average of both stocks and bonds. That's why diversification works. right? When your stocks are doing better, your bonds are usually lagging. Your bonds are pulling more of the portfolio, stocks may be struggling. That's a part of investing. And this, again, as you're reviewing your statements year in and year out, we talk about the average, but realize almost never that you're going to see the average on that statement in both your stock and bond portfolio in any given year. Matt, I'll turn it back to you for questions.
Unmute. Thank you. Thank you, Chad. That was very helpful. I think it's good to get a step back in these moments and get a long-term perspective. Certainly, fear is a very real thing, and they say that fear is a bigger emotion or a more motivating factor than the desire for more or ambition, you might call it. Certainly, I remember back during the COVID years, just the fear, just day after day after day of just the heavy fear that people were carrying. And it is very draining. It's very exhausting. And yet, when you get to the end of that, the markets finally get tired of being afraid, I think. I mean, people do, when they realize that it's not the end of the world, we're going to get through this, people are like, okay. And that desire for improvement of my life comes back. And that's a powerful thing too, to think about, that's still there, right? Even though there's fear here, there's also ambition. There's also desire to improve your life and to have what you need to take care of your family. So I think that's probably the one thing I'll say about long-term investing is it gives us a chance to really improve things for ourselves as well as for those we care about. All right, so just a few questions and we'll wrap things up. Thank you again for being here. We've got a great crowd on tonight. And if you know someone who wasn't able to tune in, we will post this recording out on our website as well as on social media so folks can watch it later. But definitely a few questions here that I have on my screen. We'll start with Armand with Capital Group. If you would, we just a thought here about, okay, Daryl Spence, one of your economists, recently wrote a piece about that tariffs, as announced, have the potential to significantly weaken the U.S. economy, if not cause an outright recession. There's that R word, right? And of course, not all tariffs get passed along to consumers, he said. It is certainly possible that some get rescinded. However, the grandeur with which this policy was announced makes it seem unlikely that a lot of it gets reversed quickly. I'm paraphrasing a little bit. If recession is becoming more likely, how does Capital Group, what is Capital Group saying about asset categories, places to put money that would be good in this environment?
Sure. A few things. One, we have a number of different economists here sharing different thoughts and views on the market. With that, from a high level standpoint, how do we feel like investors should prepare themselves for a recession? One, stay calm and focus on that long-term perspective. Focus on your plan and not the information that's being shared in the broader indices. Two, and I'm sure Matt and the team already has a balanced and broad, diversified portfolio for you all, but diversification is key. And in times of recessions, some companies are still profitable. There are companies who, yes, they may be going through tough times, but during a recession, whether it was 2008 or the quick recession that we had during the pandemic, folks are still going to go to the doctor for the most part. I mean, even take the pandemic out of it, folks were finding a way to go to the doctor. But if we go back to 2008, which many of us went through, there were companies who were still seeing customers in their line. If you go to a McDonald's, if you go to a Walmart, if you look at the consumer staples sectors, like consumer staples, healthcare, energy, for an example, these and utilities as well. These are sectors within the economy that, whether we are in a recession or if the economy is booming, these are key to our day-to-day lives. We all need toothpaste, we all need food, and we all need the doctor as well. So um, I'll put a bow on it by saying stay calm, focus on your long-term plan, and you want to bolster your portfolio with companies who have weathered storms and weathered recessions in the past.
Said. I think that certainly, yes, we do have diversified portfolios for our clients here. And we have shifted some things around even earlier in the year. We did with the eye towards more volatility. We're constantly reviewing with clients. We're constantly talking with folks about ways to stay diversified. And we are looking at that really daily as we get new information. And we're talking with our product partners like you guys as you have all the research capabilities with your firms. So thank you for that outlook. Nick, I want to share this next question with you. This is in regards to JP Morgan's recent estimate that the S&P 500 would end right around 5,200 this year. Granted, that was, I think, posted maybe before the rally and the relief that was announced, the 90-day pause that was announced a couple of days ago. What are your economists saying now, if anything different than that? And with that in mind, how do you guys recommend folks allocate capital?
Yeah, sure. Thanks for the question. So, number one, never listen to our economists' forecasts for the equity markets. They're all PhD, brilliant individuals, and they're always wrong trying to cut the S&P. It's too hard. They're really smart, though. Listen to their economic data. But a couple things. Based on long-term, and I read this earlier, based on long-term return estimates for JP Morgan, yesterday's return, which was the 10th best in history, basically gave you 1 year and 5 months worth of equity returns in a single day. So to what Chad was talking about, like you just cannot afford to miss these days, correct? Even though today is down. How would we be thinking about things from an investment standpoint? Maybe three ways. All right. And let me tell you the negative here. Like out of the 17 times, I think dating back to the 50s where the market sold off more than 15%, there's only been four times where the market actually finished up. All right. But when it did, like gains were north of 10%, which could happen considering the dramatic policy that's being enacted and the way that could change. But we want to acknowledge the inevitable, which is it's tough once you see a 15% plus sell-off to really see a great market return. Not saying that markets can't go higher from here and still be negative by year end, but number one, we want to stay invested in the US if that's the case, but I think you can use strategies that employ options to either buffer the downside, or you can use US equity strategies that actually write options to generate income. And so there's option writing strategies on the S&P that will generate 7 to 9% regardless of what the market does. You can write options on the NASDAQ and get 10 to 12% regardless of what the market does, down, up, sideways. However, you have to give up a little bit of the upside for the bird in the hand of really, really high income. But if JP Morgan's right and this market finishes at 5,200, we're at 5,200 right now. That's a flat market. A flat market, you can just clip this income all day and be successful. So that's number one. Number two, this old acronym of TINA, which is like there is no alternative, right? Which applied to the US for a long time. I don't think that's the case anymore. Concentration risk is huge in the US. Most of the market downturn at the beginning of the year had nothing to do with tariffs. It was all about artificial intelligence and tech stocks, which we found out that China could develop AI that was pretty darn good. And all of a sudden, the US AI took a hit and the Big Mag 7 went down, driving the rest of the market down. So think about diversification into international. Nobody wants to hear that right now. International has lagged for over a decade, but the US is fiscally tightening right now. We're imposing austerity. The rest of the world is stimulating. So you may see capital go out of the US, which it hasn't done in a long time, to the east. Europe, really liquid, really deep. We shouldn't be tied at the hip with Europe anymore. You haven't seen it this year. Europe's been up a lot more than we have been, before maybe yesterday. A lot of it is currency based. The US currency we think is really, really rich. If that were to come down, that enhances your international returns. And you have just much, much better valuations outside of the US. All right. So we would divert a little of your assets there if you don't have anything, not a ton. And then lastly, like just about every type of bond that you can buy, treasuries, mortgage-backed securities, securitized debt, it's yielding a lot more than its 10-year average. All right. So there's plenty of income in fixed income. And if we could get you mid to high single digits in fixed income with a third of the volatility of the stock market, I would take that all day. It doesn't need to be all of your portfolio, though. The problem with bonds is inflation. If inflation stays at 3, or if it bubbles up to say maybe 3.5 because of tariffs, which people think might happen, and you're only getting 4.5, 5% from like a really high quality bond fund, like your real return after inflation is not great. So over the long run, you still want to be in equities. Equities are, I think, the kryptonite to inflation. So maybe those would be the 3 or 4 things we'd be thinking about.
Great. Thank you for that answer. I didn't know exactly how you would answer, Nick, but we have all 3 of those strategies in our portfolios. So that's good. We certainly appreciate those perspectives from both of you guys. And then Chad, I'll share this last question with you, and I believe it's the last question we have here. During the first year of the first Trump term, the stock market got off to a rocky start. At one point, the S&P was down about 20%. It finished 2018 down a little over 4%. But then in 2019, it took off and was up about a little bit over 30%. What's different this time? Is there anything different this time, or do you see that potentially being a pattern?
Great question. And to everyone, I didn't know Matt was going to ask me a history question. So I got to go back through and make sure I can remember what was happening in 2019, even though I forget what I had for breakfast this morning. But with all that being said, I don't know, right? I think a lot of us talked about it's tough to have a crystal ball. I think what I did highlight from Vanguard's perspective, when in doubt, zoom out, right? And investing over time, there are going to be some downturns that you're going to have to weather. And whether we end up or down or sideways this year, we're all going to find out December 31st. But I will share a few things to think about. One is the fact that from 1980 to 2024, on average, the intra-year low was the S&P 500 being about down 14%, okay, over a 40 plus year period. 75% of the time in that 44-year period, the S&P 500 was up, ended up, right? So those are pretty good odds in terms of saying like, hey, on average, I may be down in any given year, double digits, but 3 out of 4 times the resilience of the U.S. consumer, the resilience of the U.S. economy shows itself through. And the last thing I'll share is right now we're talking about tariffs. And if I take us back just 5 years, think about all of the things that we've experienced, right? If we were in 2022, we would have been talking about a global pandemic and COVID. And we saw what happened there in the way that we were able to weather that. If we were at the beginning of 2022, we would have been talking about Russia and the invasion of the Ukraine. And is this the beginning of World War III? And then later in 2022, we were talking about the Federal Reserve and how rapidly they were raising interest rates from 0% to over 5%. Now we're talking about tariffs. At the end of the day, we're going to be talking about something else in the future. It may not be the same. It likely will rhyme. I'd leave everyone with the fact of saying, hey, 75% of the time over a 44-year period, S&P 500 ending up, but yet having to, stomach that 14% on average downturn in any given year.
That's great. That's great perspective. Thank you. We appreciate everybody being on tonight. Hopefully we didn't take too much time out of your busy schedule. I hope you found this valuable and helpful to you. Please do us a favor and share the link with a friend once we send out the replay. We'd love to answer any questions that folks have. If you are nervous or concerned about your portfolio in any way, shape, or form, it doesn't hurt to get a second opinion. If you're not a current client of ours, even if you are a current client of ours, let's sit down and talk. We'd love to talk through each of the investments that we have for you and give you some perspective on why we're holding those. And last, we'll make our attorneys happy and share some important disclosures. Thank you guys for being on so quickly. I think I reached out to each of you like 2 days notice, maybe 1 or 2 days notice. So thank you for jumping on so quickly. It has been a busy time, and we appreciate all you do. And again, to our clients and our guests, thank you for tuning in. We appreciate your time. And if there's any way we can help you, please don't hesitate to reach out. That's all for this evening. Have a great night.